Okay, thank you.
Thank you very much, and welcome to our Pensions Fund Committee meeting on the 25th of March 2024. Firstly, have we got any apologies?
We've had no apologies. Councillor Rice is joining remotely, and hopefully Councillor Beasley joining remotely as well. We haven't heard from Councillor Brown as to whether he's going to be in person or remotely.
We are pleased to announce that we are quorate, so you should be able to get to the business nice and quickly. Certainly, minutes of the meeting last the extra meeting held on the 5th of March 2024. Does anybody have any queries or corrections to make to that? No? In which case, I will sign them as a pre-record. Okay. Do we have any declarations of interest? No? Okay. Any public participation at all?
We've received no questions or statements from members of the public.
Okay. Any questions from councillors?
We've received no questions or statements from Dorset Council members.
Urgent items. Do you have anything urgent?
Nothing from the officers.
Councillor. Then on to item 7, pension administration. Over to you, Karen.
Hello, good morning, everybody. Nice to see you. Okay. Hopefully you've all seen the report. I start off with the usual key performance indicators. Can I just check you can all hear me okay?
Yes, we've
Yep.
tested the sound, and it's at the perfect level at the moment.
Excellent. Okay. So the KPIs are attached Appendix 1. These are all looking very good. Obviously, we do have difficulties at the moment with McLeod. There's a few things on hold, maybe around mostly around the transfer areas. But you know, I'm really pleased with the KPIs, continued improvement. The only areas where you'll see there isn't some improvement is the areas that we're holding back on. One of those is interfund adjustment. So that's where we pay a transfer between LGPS funds. So there's no impact to members, and a lot of those are currently on hold anyway. But where we can, we are proceeding with those. Does anybody have any questions at all on the KPIs?
No, thank you. If you want to carry on, Karen.
Yeah, okay. McLeod update. This is probably the biggest item to update you on today with the McLeod development. Mainly the big item here really is the delay in our software delivery. So you'll be aware that the new McLeod regulations came into place on the 1st of October last year. We were hoping to have software in place immediately. There was delay and then further delay, and now there's going to be even more delay. So we're left with the situation that there's a couple of items of business as usual tasks that we can perform, and there are some things that have been working well with the system in McLeod, but unfortunately the vast majority of the business as usual and the tools that we need for the rectification programme have not been delivered and won't be delivered towards the end of the year. We have met with Civica recently, myself and Sean, and the chairman of the board is getting involved as well. Hopefully Civica will be attending our next board meeting. This is a huge impact, and it's really important that the board and the pension fund committee understand the problems that have arisen because of this and will potentially be an impact in 2025. So I've mentioned here the big items for next year, which is of course evaluation year. So there's always more work for us to do in evaluation year. Next year we also have to produce our annual benefit statements for the first time compliant with the new McLeod regulations. Obviously at the moment we're way off being able to do that. And next year we have to start the dashboard programme as well. My concern here is that the rectification work that we expected for the remedy period, which is from 2014 to 2022, added to the rectification work we were not anticipating. So that's the work that has been taken place since the 1st of October last year, means an unprecedented amount of work that's going to probably be shifted to next year when we've got these other major items. So it's really important that the board and the committee are aware of this. It seems to be a little bit out of our hands, but I am concerned and I have raised concerns there. Does anybody have any questions in regard to that aspect at all?
Councillor Rice, did you have your hand up?
Yeah, apologies. That was only to let Councillor Brown in through the door, but I see he's already there, so that's fine. Thank you.
Any questions on Karen? No? Okay.
No questions? Okay. We will, of course, keep you updated, and we'll probably work more closely with the board so that they can monitor, because that's the sort of thing that they really need to be doing, is monitoring that area. It is a shame. 3.3, you'll notice there, our data, we appear to be the fund that is the most up to date with our data. You'll know that we've worked the past several months, done an exceptional amount of work. So our data is McLeod ready and good to go. But unfortunately, we've been hindered at another post. But our data is in really good condition. That is good news for the valuation, and we'll have to discuss with the actuaries how we manage the valuation if we are not, which I don't expect to be, completed the McLeod rectification work, and I'm sure that they will be able to assist us with that. You'll see as well at 3.4, draft statutory guidance has been issued by DLUC. It's only been issued to stakeholders, so that we all have that. And this is statutory guidance covering issues around McLeod. So, for example, data collection, we're okay there, but governance, case prioritisation, transfers, deaths and beneficiaries and before payment is made, and compensation. This is all very important, and something like compensation is another aspect of any delays. The compensation amount for any arrears of pension, for example, is fairly high. So the longer we wait to pay those retrospective increases to pensions, the higher that will cost the fund. There's some new GAD guidance as well that was released on 24th of January 24. And covers certain technical aspects that needed to be covered. For example, early payment of pensions, late retirements and transfers. Now, transfers, you'll see I've mentioned specifically at 3.7. Again, it's important to understand that this seems to be an area that is particularly troubled by McLeod. The software isn't in place, obviously, even for other software providers. The LGA has helped funds by producing a spreadsheet to assist them with the McLeod element for transfers for non-club transfers. However, it's so complicated now that they've not been able to produce a spreadsheet for club transfers, and I think software providers will really struggle. So unfortunately, the complexity of the LGPS scheme, the complexity of transfers and club schemes. Now, one of the reasons that the club transfers are so complicated is because they involve other public sector schemes. That's who mainly is in the club, the transfer club arrangements, and they all have McLeod remedies of their own. Unfortunately, everybody's different. So when you're moving from one club scheme to another, you have to take into account that particular scheme's remedy for McLeod and adjust accordingly. And this is where the complexities are arising. We had a transfer in recently from the civil service, and it was about 6 or 7 pages long of very complex information, really difficult to interpret what's going on and be confident going forward. So that's all being looked at a national level and will continue. Does anybody have any questions on McLeod at all before we move on?
Councillor Roberts.
Yeah, two things, Karen. You said we were one of the most advanced in our work towards it. Compared to who? Is that every single local authority scheme, or is it a group? I wasn't quite sure if we're the best in the country or how you compared. And also, what is GAD?
That's the Government Actuary Department, GAD. So GAD are responsible for issuing some of our guidance and the factors. So they're quite intrinsic to things like the club transfer arrangements. They will issue factors, for example, for our early retirement reductions, divorce calculations, etc. We've had to have new factors from GAD because of the McLeod element, and that's the difficulty there. What I mentioned there really is my confidence is around the position that we're in regard to our data. And my confidence there has really not through any official means, but really just in talking to colleagues, and I'm talking colleagues here in other LGPS funds, in meetings in the Southwest and nationally. So I'm involved in several groups nationally, including the National Technical Group and the McLeod Working Group that's been working on this recent GAD guidance that DLUC has issued. So, you know, I sort of get the impression that in terms of data, we have done a very good job, in part because we've done a lot manually. I think some of the tools that were issued by software providers for automatic updates, we have used some where we've been confident, but some have caused havoc in data. So really, that's more my observations of other LGPS funds nationally.
Thank you.
Councillor Legg?
Yes, thank you very much. For several years now, regularly it seems, we get reports that the McLeod regulations have changed or been revised. Is there any time when we expect stability for a while and that they will be in operation and stay in the same mode? Because you've been reporting for a long time now that it wasn't the same this meeting as it was, say, 6 or 12 months ago.
Yes, I mean, it is a significant change to the LGPS, and it has been a long time in coming. So it was several years ago that the McLeod court case itself happened, and it was determined that public sector schemes would have to change from the original changes that happened to public sector schemes in 2014 and 2015. So you are absolutely right. This has been going on for a long time. There's been so many consultations and so many discussions. The regulations are now in place. The one thing that remains a struggle with them is transfers. We have an additional struggle in the aspect mentioned above, that our software provider hasn't been able to give us the software that we need for business as usual and for the rectification work. So unfortunately, whilst the regulations are in place, there is some difficulty in interpreting them, which is not unusual. That's quite common, I would say, when there's a significant change to the LGPS regulation, that a lot of discussion and guidance is needed following them coming into force. And that could go on, I would imagine, for a little while. My frustration is with our software provider, that we're lagging behind in terms of the software, but we are doing everything that we can to avoid it. But you're quite right to wish for a day where McLeod wasn't top of our agenda. And if you look at the bulletins recent times, it's McLeod everywhere, and the other public sector schemes are the same. Hopefully, Howard, it will settle soon, and we'll probably then be moving on to the dashboards, I expect.
Good luck.
Thank you.
I do kind of feel certain that as soon as one area gets a bit of stability, another area changes. Well,
Yeah.
the nature of government policies. Councillor Supple, you know.
Yeah, thank you. Karen, this software, can we just go back to the software? So it says it's delayed again, November at the earliest. Is anybody else using software that actually works? Is there different software out there or are we typical?
Well, that's a good question, and it's a question that we have addressed recently. So in terms of LGPS administration, there are 4 software providers in the country that can provide software for this work. This is quite complex, so there's 4. Out of the 4, there are 2 main players only that provide software for LGPS administering authorities. A couple of years ago, we moved from one to our current provider, which is Civica. Our previous provider is further ahead than us. There is no doubt about that. So there is another software provider ahead of the game compared to ours. The other 2, who are smaller players, Equinity and Capita, are probably about the same as us, a little bit behind. So there is. Now, in discussions with Civica recently, their response to our questions around this was, well, you know, you're not comparing like with like. That is what they're saying. There is an element of truth in that, in the sense that the system that we have is vast and it's huge. and it's complex, and therefore the job is harder. My concern is that it's maybe too complex, because you will know from previous experience, regulations change a lot. And we've got these new regulations. I have absolutely no doubt there'll be another court action. There'll be changes coming along. There always is. So it's important that software can be adapted and changed going forward. So the answer to your question is, we are in a similar situation to some others, but there is one other provider that has managed to complete more than our software provider.
But at what point will we draw a line? What point will we say, because November seems to be, it says earliest, so that means to me that's not going to happen. So what point will we say March 25, we can't go on like this, we should change? Or will we just, because the further we delay, the more difficult it will be to administer the scheme for the of the pension. So surely at some point we're going to have a discussion where we say enough is enough.
Yes, we're not quite at that position at the moment. We did meet with the senior managers of Civica last week to discuss this issue. And I would say that we're probably at the beginning of a journey where we really have to try and make this work. There are lots of reasons why calling it a day with this software provider is complex and costly and not ideal. When you imagine it, you're looking at a good 2 years to change a system, and the system we have got is better than our old system in so many ways. So we've got a good system, but there are problems. So our tactic now is to try and address those problems so that we can keep the good system that we've got, but we need it to work. And we're not quite yet at the position where we say, right, okay, enough is enough. So I think with the board, we need to work with the software supplier and see how things develop and if they can deliver as promised. So I will keep you updated with that, because it is a concern, and I think you're right to be concerned. There are changes all the time, and they've had problems, and this is problematic. So we're not at a place yet, but we'll have to see things go, I think, over the course of the next year.
Maybe at the next meeting with the senior execs, I'd show the minutes of this meeting, maybe. So
yes.
Thanks,
Yes. Okay, thank you.
Thank you.
Thank you, Councillor. Okay, Karen, would you like to carry on?
Okay, so moving on to item 4. This is the abolition of the lifetime allowance. You'll probably remember that the Chancellor abolished the lifetime allowance in the spring budget last year. However, it's sort of gone away, but what they have done instead is brought in some new items for us, some of which bear a striking resemblance to the old lifetime allowance. So these new rules come in from the 6th of April 2024. We've got a couple of new items: the lump sum allowance LSA, which is set, interestingly, at 25% of the lifetime allowance, which was the maximum lump sum you could have taken from your pension before. A lump sum and death benefit allowance of 1.073 million. So that is the old lifetime allowance. An overseas transfer allowance of the same amount again. Now, we do pay some overseas transfers. There's quite a lot of tight rules about paying transfers overseas. We have to pay them to certain registered overseas pension schemes. We call them CROPs. So there's a lot in place. We do not pay a lot of overseas transfers, but there is a limit on that. There is also this new transitional allowance. And until the detail came out, I don't think I was aware of this, but this will be complex. And here again, we're going to need changes to our software and a lot of changes to our communication and to our training. So basically, if somebody has access some benefits under the old lifetime allowance, that impacts the new lump sum allowance going forward. So more complexity for us to enjoy there. Does anybody have any questions in regard to that? No? Okay. The Spring Budget 24, I've mentioned that because I always will mention it, but there isn't really much in there for defined benefit schemes. There was some changes for defined contribution schemes. And you'll be aware as well of the Chancellor looking for more closer monitoring of LGPS funds throughout the country. So that will be something I'm sure that you will be discussing going forward. And that's to do with the UK equity allocations. TPR's General Code of Practice. This has been, again, a long time in coming, and this was finally published in January 24. It replaces older codes as well, bringing things really together. So I think it's fair to say that this is still being looked at to see what LGPS funds need to do. I think that, which is quite reassuring, the TPR has said, based on its research, governance administration in the LGPS is of a high standard and there is good governance in place. So we will be looking at this and we will be reviewing our governance. No action is necessarily going to be taken immediately. We want to have a look and see what is required first, and then we will take action from there. And finally, just to mention again, just to keep this up as an item, because this will be another significant development, just to, again, a further update on the dashboards. There's always a lot going on with the dashboards, but there is more updates, FAQs, training and information provided by the Pensions Dashboard Programme, should you want to have a look at it. One area of discussions that I'm involved in is how we're going to interact with our in-house AVC providers in regard to that. So that work is still ongoing. We still haven't decided who will be the ISP provider for the Dorset Pension Fund. The ISP provider will be the link between us and the dashboard. So we will be looking at that going forward. So that's everything on the report. Does anybody have any questions?
Yeah, Councillor Roberts.
Thank you, Karen. It's increasingly complex. Have we had to take on more staff to deal specifically with the new introductions of complexity?
Yes, we always knew that we would be allocated any resource that we needed for the McLeod work, and we have been lucky enough to recruit some really good new staff in recent times, and we've got quite a stable workforce again now, and that's really good, because I think a lot of funds struggle because of the transient nature of their workforces, whereas we tend to enjoy, we have historically quite a stable workforce. So we went through a very difficult time during the early pandemic. That seems to have settled. We have managed with the staff that we have got thus far. The difficulty will be going into next year, of course, when we will really have to sort the rectification work. The difficulty, as always with the LGPS, is finding staff that are knowledgeable. You tend to home grow. It's very difficult to find somebody new to a team that can actually hit the ground running. But so far, we have not had a resource issue. And we have been fine. So what we intend to do is keep our resources as high as we can to get through this difficult period. And it may well be that in future we can reduce our staff numbers, but at the moment we're keeping them at the level they are, and we're fine at the moment.
And all that staffing increase comes out of the administration of the fund rather than anything from Dorset Council.
That's right. Yes.
Thank you.
Any other questions? No? Okay, well, thank you very much, Karen, for that. Very thorough, as always. And thank you for keeping us up to date and in touch with everything that's going on. Thank you.
Thank you very much. If it's okay, I will leave you now, but very nice to see you. Thanks very much, then.
Bye.
Cheerio. Bye-bye.
Right, moving on to item 8, the pension fund investments. And there was a slightly different format. I think you're going to talk us through.
Yeah, hope it's not too exciting for everyone, the new format. So just to introduce myself, David Wilkes, Service Manager for Treasury Investments at Dorset Council. So as Councillor Cannings, as the Chairman's just said, in response to some feedback we got, particularly at the November meeting, about whether we could look at reducing the size of reports, and making better use of appendices or adding stuff onto a website for supporting detail. We're trialing a new approach today in terms of how we report investment performance. So the report that was previously known as the Fund Administrator's Report is now the Pension Fund Investments Report. It includes 2 reports as appendices that were previously separate reports. So the Independent Investment Advisors Report from Steve Tyson and the report on a quarterly basis from Brunel on performance of the overall pension fund, but also more detail on the performance of Brunel funds. So currently there's no more or less detail than what you've had before. It's just presented in a different way and not as a sort of first step really, but we're always happy to take feedback on the content and the way that it's presented. So in the brief summary of the covering report, we've attempted to draw out and highlight the key points from the investment performance, the economic and market background, etc., etc. But we've got Steve Tyson on hand to expand a bit more on the economic and market background and how it impacts on our investments. And we've also got Tim Dixon, and I think that might be Simon Wood at the end of the long table from Brunel there to talk and focus perhaps more on the detailed performance of the Brunel funds. So unless Brunel's view of what's happening in economies and markets differs from Steve's. So if I just move briefly on to the key points that we've tried to tease out in the brief summary, without wishing to read through it verbatim. We've got the performance figures there for the various time periods. So for the quarter to 31st of December, the return was 5% compared to combined benchmark of 4.5%. Over 12 months or over the year to 31st of December, 9.7 against 8.8. But we're still down over the medium term comparators of 3 years and 5 years. So 4.5 compared to 6 for the benchmark for 3 years, and 5.8 compared to the benchmark of 6.4 for 5 years. So the big factor in the economy and markets in the quarter to the end of December were falls in inflation were seen at a faster pace than had previously been expected, and in return that led to expectations that interest rates might start to fall faster than had been expected, and ultimately that led to a rally in most asset classes. And then the other kind of key theme is what we've discussed at previous meetings is the emergence of the so-called Magnificent Seven, of the really big stocks, Apple, Amazon, Alphabet, which is Google, I think, Meta, which is Facebook, and Nvidia, Microsoft, and Tesla. We're seeing those 7 stocks really driving performance of markets. We are, in terms of assets transitioned across to Brunel, just under 80% of assets are now with Brunel. The main exceptions to that being our property investments through CBRE and some legacy holdings that we have in private equity and infrastructure. And we also, at that point, had corporate bonds as well outside of the pool. So I think the last point in there, which we look forward to hearing from Steve and from Brunel, is that the environment is at the tail end of 2023 was much more supportive or benign for Brunel's approach, and the direction of travel that we see interest rates going in, it is central to the performance of Brunel. And where we are at the moment, we're anticipating that will be a more benign, more favourable environment. So that's all I wanted to say. So I don't know if we're going to take questions now or whether I want to just hear from Steve initially first, or
yeah, I think if you do the reports first and then we'll have questions together.
Yeah. And Steve, over to you to.
Okay. Thank you. I should just introduce myself. Because there's one member around the table that I haven't met, that's Councillor Suttle. So good morning to you. I'm the Independent Investment Advisor to Dorset. And apologies, I can't be with you in person this time. Normally I'm there, but I can't be with you today. My report is, I'll perhaps start there on because my report is about Q4, which seems like an awful long time ago. So I'm going to really talk about Q1 as well. So my report on table 20, the table on page 29, you can see that most markets were pretty strong in Q4, as David previously mentioned, up between 5 and 11%, even 12% in Q4. Bonds were also strong in that quarter, but let's talk about Q1 as well. So in Q1, it's really kind of been more of the same. For example, the FTSE is up 3% this quarter, but the S&P is up something like 10% this quarter. And so equities are continuing to be strong, essentially. Now, with 57% of our portfolio in equities, that's obviously good news for us. So that's good. Now, what is going on? I think essentially there are two things that I need to talk about. One is the fact that we seem to be avoiding recession. And the second thing is that inflation is falling. So now there's a debate still going on amongst economists whether we've avoided recession totally, whether it's done and dusted. There are still some people who are arguing that the lead effect from the interest rate increases that we saw a year to 18 months ago are still not yet fully felt, and that we're not out of the woods yet. But certainly some economies have flirted with recession, and it just felt like recession at times. Germany, the UK, as the Fed and the Bank of England and other central banks have raised rates. So we're not completely out of the woods yet, but essentially employment has stayed relatively full in the main economies. And the consumer built up a lot of savings during COVID, and that has been a cushion really for consumer spending, despite the cost of living crisis. So it increasingly looks as though we might avoid a bad recession, and the central banks are now more in a position. And certainly the discussion, the day-to-day discussion in the markets is all around, the rate cuts, when rates will be cut, the timing of those rate cuts, and the central banks being in a position to lower rates as inflation falls. And the markets, the equity markets, are obsessed by the expectations of the Fed and other central bank action. All that said, there's I see even in the Financial Times today, the chief of the Congressional Budget Office in the States, which is the watchdog, which oversees the level of debt, is expressing his concerns about the level of debt buildup in the state, in the United States. In fact, the headline, talks about how the debt buildup could eventually result in a Liz Truss style market shock. We're at high levels of debt in the States, and there's been concern about this for quite a number of years, but it continues to build. But that may not happen. Predicting the timing of that is almost impossible, because it's a gradual process. So we've got all the stuff having to do with the economy, inflation, the debate around interest rates, the level at which inflation falls. The second factor in the US that has particularly driven the strong S&P 500 is technology, AI, the Magnificent Seven, those stocks that David previously mentioned. And it's not just expectations for what's going to happen to those companies, it's what's actually happening in terms of their profits. They've been reporting very good corporate profits. And these are giant technology companies with huge economic moats. And one of the challenges for Brunel's, the managers that Brunel appoints, is navigating those. I'll come back to that point again when we talk about performance. So in terms of performance in Q4, after the fund, the Dorset fund was at 4.9 versus 4.5, so better than the benchmark. 2023, 9.6 versus 8.8, also better than the benchmark. So some improvements going on. And that's essentially due to welcome performance improvement from the Brunel sub-funds, the Sustainable Fund, UK Active, emerging markets, better fourth quarter. Multi-asset credit had a very good year. There's still a couple that were behind in the quarter, Global High Alpha, Global Small Cap. Perhaps we could ask some questions about those. We've discussed at the previous committee meeting, which we discussed strategy, that Brunel faced headwinds in 2022, particularly due to the Ukraine war and the energy stocks being very strong, due to rising interest rates being bad for growth stocks. Those headwinds are abating. And certainly are, the conclusion, if you recall at the last meeting, we're going to see how well Brunel does in a year like this year with hopefully an absence of headwinds. One of the things I mentioned in my report that I observed just back on that Magnificent Seven point is on page 6 of the Brunel report, they aggregate all the underlying equity holdings from all their underlying managers. And I thought it was interesting that that 5 of the Magnificent Seven appear in our top 10, as you would expect. But what was interesting to me was the fact that the 2 that do not appear were Tesla and Meta. And even from my kind of remote distance to the actual what's going to the actual companies, I can understand some of the kind of governance concerns around some of those stocks. Tesla, obviously, the Elon Musk thing, and Meta. I can understand how that arises, and I'm sympathetic to that, and I'm generally sympathetic to the difficulties that Brunel and their managers will have in navigating those big stocks, those big technology stocks in the market. But our expectation is that they can navigate that and that they can produce outperformance. I'm going to talk a little bit about strategy now. So we had a big change in our strategy 18 months ago. You will recall when we removed the liability-driven investment mandate with Insight and moved that into growth assets, which was a split of equities and corporate bonds. And that was a good move, given what's happened in the market subsequently. We reviewed our strategy in 2023, and we found that not much change was necessary to our strategy overall. And recently, as you will recall, we reviewed our equity strategy. Again, there was only one relatively minor change, which was the move that's happening in the climate to climate portfolios to consolidate that. But if you recall, there were several things that would be continue to be on watch and to be checked again in 12 months' time. And that was the performance of some of the Brunel sub-funds, the passive versus active debate. How well will Brunel do in an environment where the headwinds are not so strongly against them? And then there are other things that we're keeping a close eye on, how the UK active mandate develops, because there's a proposal out there which we're essentially very supportive of, how the smart beta mandate develops, where Dorset is the only client in that mandate, and we'd like to see some development of that, as well as Brunel's overall performance. And final on strategy, just a reminder that although it doesn't seem very long since the last one, the next triennial valuation, the triennial actuarial valuation, is in March 2025, so just 1 year away. The next section that I was going to talk about very briefly was some questions for Brunel, because I hadn't anticipated that Brunel would be, I was going to set up the questions that you might like to be asking Brunel, or I can ask them on your behalf. But I've got 4 or 5 things that I was going to raise. But I think given the structure of the meeting, I think it's Brunel being in the room now, it's better if we just deal with those after Brunel have talked. But maybe we might invite any questions for me at the moment, if there's anything on the background that I've laid out now before we, I guess, turn next to Brunel.
Does anybody have any specific questions for us, Steve? Councillor Roberts?
Chairman, it was really a question early on David's summary. My perennial question about employer contributions. I do remember celebrating that when we achieved 3 billion fund. We're now at 3.78, I think. At what point can we reduce employer contributions as the fund continues to grow?
I'll try and respond to that. I was going to say I'll answer that question, but I think I'll respond to the question. So, yeah, it's great that the assets have increased by that amount. Unfortunately, the liabilities are also increasing on the other side of it. We are, as it says in the report, we are getting, you know, the funding position is improving, has improved over each of the sort of 3-year periods. As Steve Tyson just said, the next actuarial valuation will be based on March 2025 data, and at that point we'll get an updated position in terms of where our funding position is, and then it will be for the actuary for us to discuss with the actuary where employer contributions are. I think everyone would, you know, share the ambition that we would want to reduce the burden that there is on the scheme employers. However many hundreds of scheme employers there are within the fund, so it isn't just Dorset Council and Bournemouth, Christchurch and Poole Council. There's all the other employers as well. I think the actuary will always take a conservative approach to that, because the last thing we want to do is reduce contributions and then have to put them back up at a future point, because then the contribution rate will be even higher and the burden will be even higher on the employer. So the time to be asking that question is when we get into the next actuarial valuation with the actuary, and then we'll be looking at our investment strategy as well, in terms of where we are in terms of the funding position. Is it an opportunity to take a bit of risk off if the funding position has improved? Is it an opportunity to take a little bit of risk off the table? The other thing that we'll need to factor into when we get into that actuarial valuation, or not the actuarial valuation, but then the review of investments afterwards, will be the fund is maturing in terms of its cash flows. So what that means is that if you wound the clock back 10 years ago, the contributions that were coming in on a monthly basis from employees, scheme members and their employers was quite a bit higher than the benefits that were being paid out. As the fund matures, in common with other LGPS funds, then we're now at a point where in the last year the contributions and the benefits were virtually the same. So the cash coming in and the cash going out was virtually the same. At the next review, one of the things we'll need to factor in is that we would probably be reaching a position where the contributions, the cash that's coming into the fund from contributions each month, isn't sufficient to meet all of the benefits that are going out. So that will be a factor that we'll need to take into consideration in terms of the liquidity of our investments as well. A long response to your question, but I think, you know, clearly it is something that I think we all need. I'll try to say that every pound that we can generate from investments is a pound less that the scheme employers need to put into the fund. But any reduction to contributions will be done in a very, I would say, conservative manner, and not wishing to reach a point where we have to go back and then put contributions. Once we start cutting contribution rates, we don't want to be in a situation where we need to put them back up, because then the pain, I think, will be even greater for the scheme employers.
Thank you. That was a very clear explanation. May I ask Aidan, just on that, what 1% of Dorset Council's employer contribution amounts to in monetary terms?
Can I count? Aidan Dunn, Executive Director, Corporate Development, Dorset Council. Can I come back to you on that? I'll do a quick calculation. I think just it's worth noting that this debate about contribution rates is a national one, and if you look at local government pension schemes across the country at the last valuation, 2022, the schemes were 107% funded. So we're actually not quite up there. So this is a national debate, and a number of local authorities are thinking about it. We have to be very careful about the conflict of interest that we have here when we're talking about this issue of contribution rates. We've got to have our fiduciary duty on the pension fund hat on versus our employers' hats. We have to be very, very careful. And as David so carefully outlined, it is something we should think about. Let's wait for the next valuation. But the figures are quite significant. So let me do a quick calculation. I'll come back to you during the course of the meeting.
Thank you.
I just want to, something for Steve to give you some thought to, about whether there is any academic work on this subject. You know, I mean, is there a level, 120%, 130% of funding, that sort of thing, when really we should be reducing our investments in that scenario? Or I mean, is there any academic work that's been used to look into this already that we can examine?
I mean, I think it will come back to the previous discussion. That's really an actuarial question for the actuary. So it'll come back to the previous thing of once we start to get to above 100%, 110, 120, then obviously the actuary will look at that and give a very cautious judgment as to whether contributions can be reduced. I mean, the theory behind it is obvious. As we get better funded, we'll be able to reduce contributions. But there's no academic. It's really actuaries who answer those questions, really, rather than investment advisors.
I was just wondering if there was anybody looking at this from a theoretical approach rather than necessarily from an actuarial approach. Whether there's anybody from outside our close to the world, basically, that looks at this matter.
Yeah, I mean, I think it will definitely come back to a discussion next year. I mean, I can't cite any academic papers that come out of the investment markets, basically. So I think it comes back to the previous answers were correct. Yeah.
Sure. Any other questions? No. In which case, I think we'll probably go on to our colleagues from Brunel. And then, Steve, do you want to give your questions after they've talked, or in advance?
Yeah. Great. All right. Thank you. We'll just do brief introductions as well. So I'm Tim Dixon. I'm head of client relationship at Brunel, and in the room in the Brunel offices is Simon Wood, who's our head of listed markets. So I'll hand over to Simon.
Good morning, everyone. Apologies, I'm in a new room that's with new screens and stuff. So for some reason, it's got me right in the distance, so you can't see my handsome face, I'm afraid. But hopefully, the camera might come forward, and as I start talking, it might zoom in on me a little bit more. But hopefully, you can hear me. So it's probably the most important part. Hopefully,
you are a bit echoey. I mean, you can do about that, but you do sound a bit echoey.
Sorry. There's too much about that, I'm afraid. So yeah, listening to what Steve has said, Steve and David have said, markets were pretty strong in Q4 and have continued pretty much Q1 as well. I would think, if you want to touch on Q1 as we're going on, bearing in mind we are in March now. We're talking about Q4. I think what was pleasing for us, probably, after what was a tricky Q3, you may recall. But 6 out of the 8 active funds that we manage on your behalf outperformed, and against their benchmarks, but they also 6 of them have also outperformed against their peers as well. So because we're often saying to you that the benchmarks are not necessarily representative of what we do, bearing in mind the sustainable RI approach that we've got to portfolios. So they're not always the most meaningful benchmarks, but they're the most meaningful benchmarks that we've got. There's nothing else we can switch to. So we do like to show you how we're doing against our peers as well, just so you've got an idea that, hopefully you can see that we're not totally incompetent and that we are, we are capable of managing the money for you. Interesting, Steve, I mean, if you want to ask me questions, Steve, as you go, because that might develop the conversation a little bit more. But, Steve's comments on the Magnificent Seven are quite interesting as well, because if you look at our 2 global funds, the Global Sustainable Fund and then the Global Alpha Fund, you can see that in most cases we're underweight in the Mag 7. We've got some exposure, but if I looked at Global Sustainable, for example, 0 weight to Apple, which is 4.47 of the benchmark, 0 weight to Meta, which is 1.2 of the benchmark, 0 to Tesla, which is 1.06, and that would be more on. I think valuation would come into it as well, quite frankly, from the Mag's perspective, but a lot of it would be about RI, about sustainability and stuff like that. Apple, for example, a lot of people are worried about supply chains and what's going on in China, where part of the supply chain is. So people aren't investing for that reason. But year to date, that's been quite helpful to us, because when we've spoken about the Mag 7 before, and they've all kind of gone up as we did in Q4 last year, you can see this year that there's divergence in performance. So Apple and Tesla are actually negative so far this year. And so, so us having zero weight there in sustainable has certainly helped our portfolio. Now, why is that? Well, probably, AI is still a big theme. I'm sure you guys can't pick up a paper without seeing AI being mentioned. And there'll be a question mark whether Apple and AI really are AI stocks. I think it'd be fair to say they probably are. Whereas Nvidia, Microsoft, etc., much probably Nvidia certainly, with semiconductors, but Microsoft as well, doing a lot in the AI space. So we're seeing those stocks picking up. And if you look a bit more globally, TSMC, ASML, who also do sort of chips and things like that, stuff that will help out AI, they're the stocks that have been outperforming so far this year. Going back to Q4, because I realise that's the point, but please fire questions at me on year to date as well if you want to. Going back there, I think one of the comments I made in our last meeting was that if the market broadens out a bit, so although the Mag 7 continue to outperform, we did see other stocks start to outperform as well. We saw a broader performance, which was helpful to our portfolios, because as we've mentioned, we are underway the Magnificent 7. So by that portfolio performance spreading out a little bit, it certainly helped our portfolios and helped them to outperform. Although I would, as Steve touched on, Global Health did underperform at the back end of in Q4. So a little bit disappointing there. And the other one that underperformed was Global Small Cap. And that was very disappointing because all three managers underperformed. And bearing in mind we've got managers who are doing different things in the portfolio, it would be a surprise that they all underperformed at that time. But I'm pleased to report that year to date, up until yesterday, the Global Small Cap Fund is up 6% against a benchmark of 3.8, so 2% ahead. And two of our managers are outperforming. American Century is outperformed by 5%, and Montanaro by 3.2. And they were the two laggards. American Century in particular was a very poor performer in Q4 last year. I had a meeting with the lead manager who came over from the States in January. He was incredibly apologetic about how poor the performance had been. There's no getting away from the fact that the performance had been poor over the year. But he was keen to reassure me, and he was producing longer term charts, because obviously they've not just been running the money since we took a position with them. And he was keen to show me that how well they do. They have been through periods like this before where they've underperformed quite sharply, but it's a question of they haven't changed their process. So things are still the same. They're still doing the same things, and they just needed the market to broaden out a little bit. And I mean, it's a great performance so far this year, but we're not getting carried away, because it's still we're not even through the first quarter yet. But it's encouraging to see that when the market turns a little bit more in their favour, they can outperform. And this was the message I was trying to convey to you last year, that the market wasn't really in our favour, and it was touched on by David about interest rates. I would hate for you to think this is just an interest rate play. This portfolio isn't just an interest rate play, but it was very hard for our portfolios to outperform when rates were going up sharply. And also the energy, you recall in 22, the energy price as well was really, energy sector was up 60%. So it's very hard for our portfolios to outperform there when got such a little exposure to that area. So all in all, we're pretty pleased. As I say, so far this year, I can only look at 7 of my funds because at the moment, because that's just the way the reporting goes on some of the systems we use. But 5 of the 7 are outperforming, and now I'm talking here about the active equity portfolio. So 5 out of the 7 are outperforming so far this year. Again, because we've seen a broader performance. And Steve touched on it as well about interest rates. So back at the end of Q4, everyone said, well, interest rates are going to be cut up because of the lower inflation. And I'm talking about the US here, which is as Steve said, 60% of the market and portfolio. So really driving, it's the US that drives the portfolio performance. So we've seen that, interest rates are going to come down. Then we saw people, sort of all of the inflation figures aren't quite as good as we thought they were. So maybe interest rates won't go down. maybe, and the Fed have guided on that they don't really expect rates to be cut that far. Now they're stepping back and saying, well, we could see some rate cuts towards the end of the year. So my message to you would be, it's going to be volatile, and if interest rates are playing a key part, and again, we saw some talk this week that maybe rates could come off, and it is, one week we're saying that rates aren't going to be cut, the next week we're saying they will be cut. So it could be a slightly volatile ride, but we've got conviction in our managers, so we think we can outperform. Even if rates don't go down, we think we can still outperform. It's just that as long as they've stopped their upward path, I think that would be the thing that our portfolio has the most in, certainly in 2022. Steve,
Simon,
you want to come in? Yeah.
Maybe I can just interrupt for a second and ask you a question. So just to, you've answered the question about global small cap doing well so far this quarter. That's great news. So you said that 5 out of 7 of the active equity portfolios outperformed, so 2 out of 7 have not outperformed. Which, can I just ask which 2 of those which are having a underperforming in Q1?
Yeah, okay, so that is low volatility, so you don't hold that, sorry, so you don't hold that portfolio anyway.
Doesn't affect us, yeah.
That would be expected, so that one, emerging markets is under by 0.2.
Okay.
That's it. So
Okay.
you're not holding. And as you know, well, you may know, I'm sure you do know, but we are doing quite a lot of work on emerging at the moment. We're thinking of moving the portfolio around a little bit, and we're sort of down to, we're meeting managers again this week, so we're down to sort of a short list of 5. We're meeting managers to discuss, be there, make sure we've still got conviction in them, and then it's a question of portfolio construction and how we think these managers will fit together for the future.
Okay, but overall, you're having a good first quarter from the sound of it. Because 5 out of 7 are outperforming, and hopefully there'll be some.
We did, Steve. Yeah, we had a good year last year. I guess we outperformed last year, so as the portfolio as a whole. So I guess that could be classed as a pretty good year. I mean, I think the actual return is pretty good as well. You have sort of 9-10%. So that that's, I don't think anyone can complain about that. Especially when you think where we were at the start of the year. Where people were a little bit more cautious. If you said that basically wouldn't come down quite so much, and just ongoing fears of inflation, etc. So I think the absolute number is quite good, but the 3-year number, and it's the 2022, which we've spoken about many times. That's the one that's hurting. That's the area that's really hurt portfolios, and that's going to be there for a while. And we've got to get past that. And obviously, I'm sure you will all understand that we're not going to make it back as sharply as we lose it. Where you always lose the money much more sharply than on the downside when it's bad, then there's bad news. So we've got work to do, but we think we are in general, we think we're with the right managers to get performance. But it will be.
May I ask a couple more, another question, just to kind of.
Go ahead. It's Steve. Go ahead.
Okay, thank you. Thank you, Chairman. So on page 10 of the Brunel report, which is page 50 of the main book, there's the weighted average carbon intensity of some of the portfolios. I know we've raised this before with you in the pre-meeting about a month ago, but there are 2 portfolios there, the PAB, the Paris, and the climate transition portfolio, which show a jump in the WACC, the carbon intensity during the quarter. So could you just recap and explain that? That's perhaps more of a question for Tim or Simon, I don't know, but just recap and explain that.
I'll do it. So part of that is the calculation. So the FTSE they use revenue, whereas the other one, can I send you a note on that, Steve, because I want to make sure I get it right for you. But
I can, Simon, I can explain to some extent. So those actual products, it is in their design to reduce their WACC, their carbon footprint, every year by 7%, but that is measured by FTSE, who put the index together, using one methodology, which is based on EVIC, which is enterprise value, including cash. So the sort of market cap type measure. The measure that we're showing here is based on revenue, so it's not the EVIC, so it's a different measure. And basically, some of the carbon intensity of some of the holdings did go up on a revenue basis, and that's what's caused this difference compared to what FTSE believe is happening. So we're still having a discussion with FTSE about why there is a divergence between the EVIC measure and the revenue, because there shouldn't be, but they do use different data sources, and you can measure these things in different ways. So there's still an investigation going on into exactly why there's a divergence, but we're not concerned that we believe the product is hitting its target on that EVIC basis. And we're just trying to understand a bit more about why there's such a difference, if it's to do with the data source or just something idiosyncratic about the revenue versus the EVIC.
Okay, thank you. When Brunel conclude that sort of note, perhaps you could drop a note back to the client office. I'm sure you will drop a note back to the client officers for forwarding to the investment advisors and the committee, so that people are kind of aware of what the reasons for that are. Because, you know, at first glance, at first blush, anybody who sees that graph on page 50, page 10, might think, you know, what's going on here?
No, I agree with that. I mean, and it's complicated by the fact that we're showing something here that product isn't even targeting, and that's because we're showing the same metric across all the portfolios. It's complicated by the fact that the EU disagree with the UK on what measure we should be looking at. So yeah, I totally understand the point, and yeah, we'll if we have anything more to share, we will.
Just for the benefit of the meeting, actually, data source is a real problem, you know, because if we looked at MSCI, some of their scores, and then you looked at some of the Sustainalytics scores, you know, they're totally different. They're totally different. And we're doing some work on climate at the moment, particularly on climate alignment. We're trying to get some for the TCFD reporting, and actually the guys in the RI team are actually telling S&P where they've got their numbers wrong and how they've calculated things wrong. I mean, that's where we are at the moment. You know, it's because everyone's trying to produce data, and some of the data just doesn't look right. And so we've got people here who are actually saying that, you know, actually you need to verify your figures again, because they're not correct. You're not calculating them the way you should be calculating. They're having to have a rethink about doing that stuff.
Okay.
So data is a big issue.
Yeah, we're still in the foothills of understanding and measuring climate data, basically.
Yeah.
I've got another question. It's more of a, if I may, I'm sorry if there are committee members.
You go ahead.
Okay, my question is around an announcement which I saw about David Vickers, the Chief Investment Officer, is to be part of Rachel Reeves. I think it's got the Wealth Fund Advisory Committee. What statement can Brunel make about that? And just bearing in mind that the committee might be interested in that, that there's, you know, David's time allocation, conflicts of interest, that sort of thing.
I can answer that, Simon, if you're happy for me to. Yeah, I mean, it's not Rachel Reeves' committee. The committee is a separate body which is politically independent, but it will report its findings to Rachel Reeves. We have shared with the client officers a statement about what is involved in that. We think it will be very little time. He's just sitting there as in an advisory role to feed in his views. It's nothing to do with how LGPS money should be invested. It's really just about getting his views as someone who's been a multi-asset fund manager over the last 15-20 years. But I'm sure David Wilkes can share more information about that. But we don't believe it's going to be very time-consuming. Probably looking at 8 to 10 hours over the whole period of the quarter that the process is running. It's important to state that the body is politically independent. It's not a Labour body.
Yeah. Okay.
And Councillor Roberts, you have a question?
Yeah, was this an approval by Brunel's board?
It wasn't formally. Brunel's board has been informed. A decision was taken on it very quickly, but it was felt because it is independent in the sense it's not working for the Labour Party. Plus, we engage. Part of our remit is to engage across a whole set of working bodies, you know, to influence policy. So we didn't feel this was out of line with this. The board are aware and are content with it, but we didn't seek their initial approval. We didn't think there was any significant conflicts of interest.
I'm a little surprised that internally they didn't think there was a conflict of interest and not ask the board first whether the board thought there was a conflict of interest. It's certainly not how local authorities would operate, and it is mainly a local authority and Environment Agency fund.
All right, point noted.
Anybody else? Councillor Brown?
Look, I have to say, I'm somewhat disappointed and surprised about this. There is a well-known political phrase that field marshals do not mutiny, and in the same way, field marshals concentrate on the work of being field marshals. I think what we really do need to know.
So you do need to know what?
Because none of us really expect an election this side of October. Why the pension board wasn't consulted, and how this was communicated to Brunel? Does this fall within normal governance arrangements?
So part of our remit is to, get involved with working parties and sit on committees to try and influence policy. I don't see a clear conflict of interest here. We have obviously explained that this is going on, so there's no attempt to hide it. I'd be interested to understand where you believe the conflict is. We engage in government bodies to influence policy. The body that is running this consultation is not a political body. We have informed the clients. I think we've been very open about that. I don't know what more to add.
But perhaps I could make a comment, which is that when I saw this, I thought, oh, this, is this going to be an issue? But actually, having heard this explanation that Tim's just given, I think it's my own personal view is that it's better to be at the table than not at the table. Now, there's, I wonder, bearing in mind whatever next government we see, they will. They're very engaged in the level of participation by DB funds and local government pension funds in kind of UK equities and national infrastructure and those sort of things. So those pressures will probably, continue. They've been there for a number of years. But I think, as Tim has just said, I think it's right to be at the table rather than and to engage in policy rather than not. So I don't, I know I raised this subject, but and I think the committee should be aware of it, but I personally think that it might be a conflict that can be managed, and ultimately to the benefit of the pool and to the benefit of Brunel and to the benefit of its clients.
We've had a few indications to speak. We will get to everybody in turn. Councillor Brown next.
Yeah, it's not a question on that, but actually on the overall sort of Brunel report. I know the report's up to the quarter ending 31st December. This is a bit more recent, but I read particularly in the emerging markets bit, it talks about China and that. It's just the position on Hong Kong. There's been news recently about changes that have gone on in Hong Kong and whether there's a sort of capital being taken out of Hong Kong, what the thinking and positioning is around that. And actually just also on the emerging markets sort of equities sheets within the report. It's got the regional exposure and about 65% roughly of the portfolio is in Asia. I just wonder whether there's whether it'd be beneficial to have that broken down a little bit more in detail in what parts of Asia, because I know we got hit a few years ago with a small investment in Russia and that sort of thing, but actually just understanding a little bit more detail about how that's spread.
Sure. Yeah, Benny, I'm just trying to get onto that page. Sorry, I'll give you a second. But yeah, I think it's just the way the report, breaking it down in terms of Asia. I think that's just the way the reports run. But I'll raise that with the team and see what we can get. But what I would say is we're typically underweight China and overweight India. That would be the two big positions, which is all the management. Yeah, which is slightly concerning actually. It's quite peculiar now that everyone is talking up India as the place to invest. It's had some really strong performance, and everyone is talking down China. But they're talking China down now from a sort of RI sustainability standpoint as well, which I don't recall them doing 3 or 4 years ago when China was the best performing market. So people are now talking about, can we have an emerging market ex-China fund, and that sort of approach. But from a personal view, I think if you're a long-term investor, China's probably a good opportunity. People would have been biting your hand off to get into China at these levels at the moment. But we can't overlook supply chain issues with China, governance issues with China. You can't overlook that, and that's why a lot of managers are not in that area. The area they are in China is probably EV, electric vehicles. They're doing making good progress there. So that would be an area where we are underway, and our manager there would be Wellington. Wellington would probably have the biggest China, so probably neutral weight to China through Wellington, and most of that money is in EV, but EV hasn't done particularly well over the last year or so. So it's not been a particularly good call from them, and it's that's one of the things we're thinking about when we're reallocating our portfolios. Did I get you what you asked, or is there anything else have I missed anything for you?
Just the thinking around Hong Kong and the recent changes.
Sure. Hong Kong tends to come under China now from an asset allocation perspective, which not so many of our managers are in Hong Kong now. A lot of them are underweight. I remember when even after China came out, part of Hong Kong became part of China. A lot of people will be in property funds, and properties, particularly property exposure, was a big thing there, but we're not seeing that so much now. Hong Kong would typically be underweight as well, as part of China. So areas they like, Taiwan would be one. A lot of them have got TSMC in their portfolios, but India is the big position at the moment, and I would just caution there that we'd be wary of valuation there. India's typically always expensive. The corporate governance in India is typically better than in China, which is why a lot of the quality managers have tended to go to India. But India's doing very well at the moment, so people are very happy to talk about.
Simon, I think what would be helpful is if you could send via David to Councillor Brown the split: India, China, Taiwan, Korea, and then the rest of them, basically. And that was an underlying question there. Yeah.
Sure.
Okay, Councillor Beasley next.
Thank you very much, Chairman. Could I just touch on the subject raised by Councillor Brown, and then I'll come to the point I wanted to make, and it's this, that I've in the past flagged up my concerns about risk and how we're measuring risk, political risk in terms of China, Hong Kong, and indeed Taiwan as part of that triangulation, and making sure that we don't end up with stranded assets should things go horribly wrong in that part of the market in the future. So it's about the political risk rather than and how that impacts on financial risk for us. The point I really wanted to come back on was that raised a moment ago with regard to the work David Vickers has been doing and is planning to do through Brunel. And it's about this issue of engagement. It's engagement across the piece. And I think the policy of Brunel, quite rightly, has very much been usually focused through Laura Chappell as the CEO and Denise Le Gall as chair. Has been about having influence within the pooling part of the LGPS, and that influence extends currently very much into government, and it's absolutely right that that influence should be heard and felt everywhere where it's deemed important for the future, because without that influence, Brunel won't be able to help shape policy. And in helping to shape policy, it is very much about working with the Scheme Advisory Board as well, but more particularly directly into those other conduits, so that our voice is heard, so that those who are making those decisions at the height of government or potentially in the future have taken into account many of the issues which perhaps with our experience of pooling would otherwise not be heard. And I think it's that David Vickers will be concentrating on. I was going to touch on this in my report in a moment.
Okay. Thank you, Councillor Beasley. I completely agree with what you're saying there. I think it's very significant that obviously government has a big impact on what we do and what we're able to do. Having influence with any government or any political party is something we should be aiming for. Councillor Legg was actually next.
No, we've moved on, I think, so we'll forget me. Thank you.
Councillor Christopher.
I have a number of questions to ask. There is mention, I think, on page 30 about interest rates not coming down in the very short term. Obviously, they didn't come down on the 21st of March. They may not come down on the 9th of May. What are the prospects of the MPC cutting rates by or on the 19th of September?
So a question for me?
Yes.
I think the odds are reasonably good. I think the market is expecting I think the market is expecting a rate cut around that time.
That is my first question. My second question is that when Councillor Suttle and I were busy looking at tax returns in January, we will have read that there were great prospects for the London market to actually do better in 2024 than the EU or indeed Wall Street. What are the prospects for London in the whole of 2024, given the uncertainties that were mentioned about 4 minutes ago? What are the prospects?
That's a great question. So well, for the whole of 20, I think from this so far in this quarter, the S&P is up 10% and then the London's up 3%. So it needs to make up another 7% to catch up. I think it will depend on those big 7 stocks actually. The Magnificent Seven. If they falter for any reason, then London could well perform as well as the S&P 500. I haven't completely given up hope that the London market starts to perform better, but it's been a perennial underperformer, and so I suppose in the long term we've got to expect it still perhaps to like the US a bit.
Thank you very much. Not that I ever get too political, but being I understand that we have the benefit of Ed Davey actually visiting Dorset later this week, should we be asking him whether the Lib Dems Daisy Cooper has anybody from Brunel working for her?
Is this relevant?
Yeah,
is it relevant?
Well, I think it is relevant because I'm sure looking across at Mark Roberts, Councillor Mark Roberts, we're still troubled about this whole question of the link with the Labour Party, where Rachel Reeves is seen as a dangerous right winger, and I don't think this is a very good thing for Brunel to be doing.
I think
that's a personal perspective. I don't know if Councillor Roberts wants to comment on that.
I think you've made your point, and I think people understand what you're saying.
Yeah, it's an irrelevant point, by the way.
Well, I don't think it's irrelevant because I don't think Councillor Roberts thinks it's irrelevant. I think there is a body of opinion within this room that doesn't think it's irrelevant.
I'm not sure really we're gaining anything by having this debate at this point in time. We're in Purdah. We're not supposed to be talking about politics, and we should be careful of our making political type statements. And I think this isn't very helpful for the work of this committee to go down this path. So I'd like to draw that to part of the discussion to a conclusion. Does anybody else have any other questions? Councillor Roberts.
Yes, I wondered whether I've been hearing that there are moves in the United States to repeal an act, I can't remember, it's something like 230, that gave social media the right not to be responsible for any content that was posted. If that is repealed and they become responsible, value of our Magnificent Seven could halve, as it's several of the social media platforms. Are we aware of this move, and what are we planning to do about it, as it is so germane to our pension fund?
Steve and
yeah, that's a very difficult question, because what I might expect, I need to because I think we're all aware of the dangers of social media and obviously the high value of these companies like Meta, which are very in that space. Although I believe our exposure actually, as Simon mentioned and I touched on, is actually underweight in that to Meta itself, because this is quite a dangerous area. But my hope is that Brunel and therefore onto its managers will navigate that properly. They're aware of those managers that Brunel appoints are aware of those risks, will be managing those risks, and that's why we have the portfolio that we have, which I think is underweight in Meta, Facebook and Instagram. So those type of risks will be very much be managed at a level that's like several steps on in the process. But I'm sympathetic to the point that's behind the question, which is the dangers that are posed in society, politically, mental health, everything, to individuals and to countries from social media, as well as the positives. The positives.
Does anyone from Brunel want to comment on that as well?
Well, as Steve said, we're underweight Meta, in the portfolio, so we haven't got any exposure in either the Global Sustainable or in the Global High Alpha. So if Meta does go down, it'll probably have poor performance actually. On a relative basis.
But Simon, does that type of thing come up in conversations that you have with the managers when they are talking to you about social media exposure and risks and how they manage it? Does that feature in those?
It's not really a subject. I mean, as you see, most of our portfolio isn't really in that area now. It's moved more into AI. If you just as an aside, if you look at a fund like Polar Technology, which is I don't know if you chaps in the room in County Hall but are aware of that fund. It's a technology fund that's been going for 25, 30 years, and there's a very interesting call with the manager last week, and he said that he's coming out of that area. He's 80% of his portfolio now is to do with AI. Everything that's AI. So that would be Microsoft and things like that as well. It's not just Nvidia and TSMC, but they're just moving. He's just moved his portfolio away from that because he can see the divergence in performance. So we talk. Managers will be aware of that risk, but I think could the fund, could their stock halve? I guess nothing's out of the question, but I think there'd be, if the authorities tried to do something to Meta or something like that, there'd be a huge backlash from Meta, and I'm sure their lawyers would keep that tied up for many years. So I don't think it's something that would be front and centre in terms of our thinking or our underlying managers.
The further point I'd make is that as well as managing social media risks that Councillor Roberts just raised, there's the antitrust, the competitive landscape that the EU and various authorities are out to kind of get some of the kind of big players on anti-competitive grounds. So that's another risk that I'm assuming the underlying managers underneath Brunel are managing.
At the forefront of their thinking, and you could see that by their positioning, well, by the way that these companies have performed, that it's not something people are particularly concerned about. But that doesn't mean it's not an issue. I want to reassure you.
Councillor Sandal.
Well, on the back of Councillor Roberts' question, of course, yesterday Florida banned social media for children under 14. So if that rolls out throughout the United States, the very thing that you're talking about is actually happening. And that will give some, so that's got to be enforced, obviously. So that could give the social media platforms some problems. So that happened yesterday. So that's whether that'll be wrong. Right.
That's a very interesting comment, because if you think what China did last year, and they got absolutely panned for doing it on the education stocks, they did that last year, and I haven't seen any. Sorry, forgive me, because I was on the train travelling down to Bristol today, so I haven't really seen too much of the news. But China did that last year, and you could see how they got criticised very heavily for doing it. But all they were doing was trying to stop their children, playing on playing on their phones, and also their education. They didn't want some children to have an advantage on education over other children, you know, by paying for these after school this after school tuition. So there are always going to be issues on this sort of stuff, but I don't know if you've got children or grandchildren around that age. You know, I think you're going to have a hard job stopping them using their phones now.
But just for clarity, Simon, if what Councillor Suttle was mentioning there snowballs, that is good for the relative performance of the Brunel managers and for the Dorset Fund, is what my understanding of the connect.
Yeah, we want to be careful as to what happens to the market in general, because, you know, I'm sure you'd rather we underperformed the market by 3% if we were up 10 and they were up 13, rather than us outperform the market by 3% when the market's down 10, we're down 7. You know, we've got to make sure we get our priorities right. In fact, that we want the first thing we want to do is make a return, and then worry about absolute afterwards.
Absolutely, Councillor Roberts.
Yeah, just slightly change of subject and referencing a small debate we had at the last meeting about A, British stocks, and B, defence. Are we looking at companies like BAE? Because if we had a month ago the awarding of the AUKUS contract for those submarines, have really done something significant, and perhaps the appointment of the senior investment officer will lead to more investment in British companies, or a direction from the people he is talking to.
Did any of you want to comment on British BAE? Oh, we've got you.
There could be a position in the UK portfolio. You know, it might well be in the UK portfolio. It's not a big enough position to come up on our radar, but we can always check that. But
I think that's a fair point. I mean, there's still a lot of talk about increasing defence expenditure as a percentage of GNP, and not just the UK, obviously, but most of the rest of Europe is heading down that path as well, we would expect. Okay, is there any other questions that people want to ask? I was trying to close. Okay. I think we had a very thorough debate today, so thank you all very much. And thank you to Simon and to Tim for your views. Thank you.
Thank you.
Lovely. Thank you very much.
Thank you.
Thanks. Thank you.
Right, on to item number 9, the report from Councillor Beasley. Over to you.
Thank you very much indeed, Chairman. Well, as usual, I will split this into the two halves of Brunel and the Scheme Advisory Board. I'll start with Brunel because that was the meeting that happened first. On the last meeting was on the 7th of March, and it was not the longest of meetings, but there are one or two things to report back to the Dorset committee. The first is that the budget and the issue that I'd raised about contingency does seem to be moving ahead, and the budget has now been agreed. There are various issues raised around what are called special reserve matters, and it may be that Aidan Dunn, as our shareholder representative, wants to have a word about that in a moment. But the major sticking point, which has been around voting having to be 100%, and the proposal to bring it back to a 75% simple majority, has now been passed by all 10 shareholders. I think that's a major step forward because it does mean that no one fund has a veto over the collective decision making. That has to be right for democracy and for business as usual, I think, anyway. So that's to be warmly welcomed. The issue of the new chair recruitment, Denise Le Gall, who's been the chair from the inception of Brunel, is retiring from that role. The process of finding her successor has been pretty comprehensive, and is just subject now, I think, to that similar process of that special reserve matter issue, but she has gone through the process, and I think a successor has now successfully been found. We'll miss Denise, because she has been there as a sort of backbone to Brunel from the start. But I think we all look forward to welcoming her successor. We had at the last meeting some pretty comprehensive stuff back from Laura Chappell as the Chief Executive Officer, and preceding that we had a presentation by David Vickers, Chief Investment Officer, which I thought was especially good, and I would hope that David can find the time to come and present again to Dorset at some stage, either online or in person, probably online, because I think that would be something which would get to the heart of many of the investment issues that have been troubling our committee, and many of the points that have been raised by Steve Tyson over the last many months. And I think we wouldn't expect David to find time for us too regularly, because he's got 10 funds to service, but I think it would be timely, Chairman, if we could look at whether the next meeting might be appropriate for him to speak to us. I think we'll all get value out of that. I'm sure that we will. In terms of transition, we've seen, haven't we, from the report that Dorset, I think, is now 78% transitioned, only up 1% from the previous quarter. And actually the assets under management for the whole of Brunel, by coincidence, are at 78%. There are a couple of laggards in there, most notably Wiltshire and the Environment Agency. But that does mean that 7 funds are transitioned slightly more than we are. We always knew we'd be slightly behind the curve because of some of our investments, most notably real estate and private equity and so on. But I think that progression is always to be welcomed to get within the ethos of pooling. But I think it's important also to keep a close watch on how we are progressing compared to our colleagues across Brunel, some of whom are obviously going to be somewhat ahead of us because they're not in those asset classes. In terms of the Scheme Advisory Board, the last meeting of that was on the 11th of March, chaired as always by Roger Phillips, attended by a senior official from DLUC. By coincidence, perhaps, but not entirely, that senior official is somebody with whom the senior executives of Brunel engage on a regular basis. And it comes back to this other point, I think, because quite a lot of that input is to officials. It isn't political, but the officials need to listen because they're acting on behalf currently of the minister, and the minister is obviously very influential in that decision-making process. The minister concerned now is Simon Hoare, who is obviously a Dorset Member of Parliament, and that engagement through to the Secretary of State at DLUC, it's important to be getting those messages across, and most of those messages coming from Laura Chappell and Denise Le Gall, together now we're here with David Vickers, are very much about how the government and indeed others indeed as well who may be attaching significance to some of these issues are dealt with through those officials at DLUC. And it is about, I suppose, making sure that there is a proper understanding of how those decisions may impact on the LGPS, because what we don't want is to find that we're getting guidance, in inverted commas, which is very difficult to be compatible with our fiduciary duties. And we've all experienced that, haven't we, about which asset classes government would like to see us invested in more and so on. And so I think it's really important to the integrity of what we're trying to achieve, which is independence from political influence, that we are progressing that agenda. Other issues dealt with by the Scheme Advisory Board. The board's budget has now been agreed, and government have listened, I think, particularly through the new minister, to what our requirements are, given the extra workload expected of the Scheme Advisory Board, working with the Local Government Association. So we've got that increase, and that increase is going to be fundamental to doing the work that we're required to do. We heard earlier about the McLeod update from Karen Gibson here in Dorset. That's occupying still a lot of time through the Scheme Advisory Board, as you'd expect. And in terms of making sure that, again, there's a proper dialogue between government and the LGPS is critical to making sure we come out with a methodology that is workable, that we have the resources for, and will deliver on the outcomes of McLeod. So I endorse everything that Karen was saying earlier, and very relieved that we have really got ahead of the curve as far as the LGPS across the whole of the scheme. And I think the final thing just to say is that following the spring budget, goes back probably to my first point, investment policy and making sure of that independence is something we spent quite a bit of time talking about again at the Scheme Advisory Board, listened to by the official who was present, and making sure that that representation is reflected properly and adequately as the government and their investment policy intentions are progressed. So, Chairman, as usual, happy to take questions on either of those, either Brunel or the Scheme Advisory Board, and I hope that update's helpful.
Very helpful as always. Thank you, John. I think you've written about David Vickers, inviting him to a future meeting. So that point has been noted, idea, and I'm sure you're right in that. Any other questions for Councillor Beasley?
The person raised his hand.
Yeah, I was just going to say the point you just mentioned there, Chairman, about David Vickers coming to the next meeting. I think it's a good idea.
Any other questions? No? Thank you very much, Councillor Beasley. Very informative as always.
Thank you, Chairman.
On to item 10.
Thank you, Chairman. That's with me. This is the Treasury Management Strategy for the Pension Fund for 2024-25. So each year we come to you seeking your approval for Treasury Management Strategy for the forthcoming year. So although the pension fund has no strategic allocation to cash, we do have lots of cash flows in and out of the fund, including the member and employer contributions, pensions and other benefits going out, rental income on the properties that we own, and various investments and disinvestments as we go through a year. And just to give some context, in the last financial year of 22-23, I think I mentioned this earlier, actually, total contributions into the fund were from scheme members and their employers were in the region of £140 million, and equally benefits going out to retired members were in the region of £140 million as well. So substantial cash flows, and this is what the Treasury Management Strategy is around. It's about how we manage those cash flows, what we do when we've got surplus cash, what we do with that. And ensuring that we've got sufficient liquidity to meet our liabilities as they fall due. So the Treasury Management Strategy is the framework within which the officers on a day-to-day basis can manage those cash flows. The limits are quite wide, I would say, and it's not necessarily what we are going to do, but it gives us a bit of headroom for the unexpected happening that we can't, that we don't then need to come back to you and ask for your approval of, because the timelines are just too tight. The Treasury Management Strategy for post 24-25 is unchanged from the current year, and it is broadly in line with the Treasury Management Strategy of Dorset Council, in Dorset Council's role as a local authority. Where applicable, Dorset Council's Treasury Management Strategy goes into a lot more detail in terms of borrowing, which isn't something that the pension funds enters into. And in terms of counterparty risks and limits, the strategy for the pension fund is remains consistent with that of the administering authority. So today we're seeking approval from the committee just to put those parameters in place for 2024-25.
Okay. And any questions? Councillor Ag.
Interestingly, talk about 140 million in, 140 million out, and then there's a table here which shows where funds are invested on a fixed time basis. Sometimes not much at all, but there is up to 2 years, I see. It just when you got roughly equal in and out, it does matter whether you got the out before the in or the in before the out, or how much they fluctuate one and the other. Obviously, if it's a bit of a negative cash flow for a while, you haven't got anything to invest. So, but what is the picture of that?
I'm trying to get clear in my head which goes out first and which comes in. So actually, the pension fund is probably in a better position than the administering authority in that the contributions from employers come in around about the 20th of the 19th. Corrected, the 19th of the month, and then the benefits that get paid go out on the last working day of each month. So typically we would have that period for about 10-12 days where we might have our balances would be higher than when the benefits go out, contrasting with the council where our salaries go out on the last working day of each month, and the majority of our income from council taxpayers comes in on the first working day of each month. So we have more of a cash flow hill to climb on that side of things.
I'll contradict that one, if I may. No, because the salary's at the end of the month, and normally the council tax payment is at the beginning of the month. The beginning comes before the end.
It's a bit chicken. It's a bit chicken and egg, really. But
yeah, there's only 10 months that the council tax comes in on, and there's 12 of salaries.
Yeah. So there is a slight mistiming, and which does mean that we have cash. You know, the cash flows are more that we have to invest, but there are other things as well, like for example the foreign currency hedging that we have in place. When that crystallises, we're required to pay cash for that as well, so we need to try and keep cash back. We've got significant commitments to private markets, which the difference between private markets and listed markets is if the committee makes a decision that it wants to invest £100 million into equities, listed equities, we can do that within a matter of weeks or even days, get that money invested. With the private markets, you make the commitments, and then there's a drawdown over a number of years for that. And sometimes those can be quite unpredictable. So that's the other challenge that we have in terms of managing cash flows is when are we going to need a drawdown? When's there going to be a drawdown on the commitment that we've made? At the same time, we're also getting money coming back out from those private. So it's an ever revolving cycle with the private markets. The cash is going in, and cash is coming back out. I'm not sure if I've answered your question there. I've gone sort of off-piste a little bit there, but
you've answered it. I wouldn't necessarily say there's no questions left.
Yeah, I was just going to say the majority of the cash that we do invest, although we have these parameters that say that we can lend out for up to two years, in reality, we've never lent any money for anywhere near that length of time. Vast majority of our cash balances we invest in money market funds. So these are whether actually low volatility net asset value money market funds. So they're all AAA rated. Basically, the underlying holdings are short dated lending to governments and to companies. And certainly in the 10 years that I've kind of been involved in this type of thing, every pound you put in, you always get the pound back plus the interest rate. I think Steve Tyson might correct me if I'm wrong on this, but 20-25 years ago, I think one American liquidity fund did actually pay back slightly less than the dollar, and everyone took their money out of that fund. So while there is a risk that for every pound you put in, you don't get your pound back. That's never crystallised in the UK. And in memory that I have of it, it's happened once, I think, in the States, and with disastrous consequence for the money market manager.
Follow up with one. For the bit, I understand the two areas you're talking about where we get cash. On the very short term one, which is about income from employers and the outgoings to pensioners, that's a short term, typically the 19th to around about the 28th or 30th. Do we do an overnight investment for that?
Yeah, so the money market funds are, we can access those the next, well, up until a cut-off point in the day, which I think is about lunchtime. Does vary.
We do take advantage of them.
Yes, yeah, and the interest rates that have been payable on those funds for the last 18 months or two years has been pretty good when you compare it with tying your money up, say, for 2 or 3 months with a bank. The interest rates have been broadly comparable, and so better liquidity, broadly comparable returns, and a lower risk actually as well in terms of the credit ratings.
Just roughly as a ballpark, where we're talking, obviously we're approving or looking to approve the Treasury management strategy. What sort of monthly figures are involved? I mean, are we investing 10 million or 50 million?
Well,
just as a sort of ballpark, not precise.
Yeah.
How about 1/12 of 140 million?
Yeah,
it doesn't quite work like that because we get the other one that's coming in.
Going back to the pension fund investments report, the table, page 18, 1.1 shows what our total cash balances are or were at the end of December. So we had £73 million in our cash balance, which represents 2% of the overall assets that we have. So that's and at the beginning of the financial year, it was just under 60 million. So we tend to have cash balances in the region of about 1.5% to 2%. So that what we don't want to be in is a position where we get a notice that we need to, on one of our private markets, we have to invest money in, and then we're a forced seller of one of our other investments. So it's getting the balance right, ensuring we've got a sufficient buffer of cash. Certainly in the last 18 months, when we've seen interest rates quite high and some of the listed market, some of the other market asset classes struggling a bit, the return we've been getting has been favourable on that.
And that return goes directly into the pension pot.
Fund. Yes. Yeah. So we have to keep the pension fund's cash separate from the administering authority's cash, so it's all in its own separate accounts. Has its own money market funds, and all of that income, it goes into the pension fund pot.
Councillor Brown?
Yeah, actually, I just had a quick question on talks about the Treasury Management Advisors, Arlene Close, and so obviously Dorset Council use them, and similarly. Do we sort of piggyback on the Dorset Council sort of agreement with them? Or does the pension fund have to pay anything towards that to the Treasury Management Advisors, or is it really we just the Dorset Council as the administering authority sort of use them and we piggyback on them?
Yeah, the pension fund investments, we're using the same advice that the council's getting. So in terms of counterparty, so for example, Arlene Close, if they've got a concern about a particular counterparty, so a bank or a money market fund, they on almost like a daily basis, we get updates suggesting that if their advice has changed regarding a counterparty. So for example, a money market fund, they may say, actually, we've seen lots of redemptions coming out of this money market fund. Be advised that you don't put any more money into that money market fund. Or in some cases, they may advise that you start taking your money out, and we're using that same advice applies whether we're managing the council's cash or the pension fund's cash. We look. I probably should have clarified that we look after my team look after the council's cash as well.
Okay, well, we're being asked here to approve the strategy for 2024-25. I see all those in favour, please.
Do you need a proposal and seconder or?
Well, perhaps we should.
I'll propose.
Second.
All those in favour? Yeah, unanimously passed. Thank you very much. Moving on to item 11, dates of future meetings. David, do you want to?
Yeah, I just want just to clarify this at the moment. So what what we're suggesting for 24-25 is that the actual formal meetings take place in the afternoons, and they're all on Tuesday. I think somebody asked last time what day of the week the meetings were on, so they're all on Tuesdays. The formal meetings will take place at 1:30 in the afternoon, and the intention is that the majority of those meetings we will have a training session in the morning, starting around about 10 o'clock and ending 12:45ish. And obviously the start time of those training sessions may vary depending on what we've got. At the moment, I think those meetings are still in your diaries for a 10 o'clock start, which I'll follow up with my colleagues in Democratic Services just to get them changed. The first meeting of the new calendar, so of the new financial year, municipal year, in June, that by then we should know who will be the Dorset Council's representatives on that meeting. And there was a suggestion that the training in the morning may only be for new members of the committee on that first day. I have to be honest, I haven't really.
I think it depends on how many we've got, so obviously we won't know that until the beginning of May. So I think it asks you a bit of indulgence to be prepared to change the diary if necessary, to change what we're doing. But we'll obviously base it on the new faces we've got.
Hopefully, if we can get it into diaries, and then it's always much easier to take things out of diaries than to add them in.
Okay, so that's that. Our next item, moving into essential business. Somebody move into the public, please. Okay. You stop.